Global stock markets are stable overnight, although the volatility may be short-lived. The Reserve Bank of Australia opens up for a May rate cut, while tariff uncertainty starts to show through in Australian consumer confidence. That's coming up in 5 Things in 5 Minutes on Wednesday, April the 16th. And then in the second part of a bonus deep dive interview on the US dollar's reserve currency status, ANZ senior rate strategist Jack Chambers explains why the Aussie dollar's relationship with the US dollar is so important for Australian pension funds.
If the Australian dollar doesn't depreciate versus the US dollar whilst equities fall, then that natural hedge is broken down. That hasn't completely gone away, but we have seen in the last 2 weeks, there have been 2 days in which the S&P 500 fell more than 3% and the Aussie-US cross didn't fall. There's only been a handful of those days in the past 35 years.
But first, in 5 and 5 with ANZ, global stocks were mixed overnight as investors were helped by strong US bank earnings reports while they search for clues on the Trump administration's next tariff moves. At one point, the S&P 500 was up almost 1%, although by 4 a.m. Sydney Melbourne time it was down 0.1%, with the Nasdaq down 0.2%. The yield on the US 10-year Treasury fell over 5 basis points, while the US dollar index was up nearly 0.5%, as Treasury Secretary Scott Bessent downplayed the sell-off seen in recent weeks. West Texas Intermediate futures fell 0.4% due to expectations of higher supply. ANZ economist Bansi Madhavani writes from London that the market stabilisation may be temporary, with pending US reports on pharmaceuticals and semiconductor trade hanging over sentiment. As of 4 a.m. Sydney Melbourne time, the Aussie dollar was up 0.6% at 63.56 US cents, and the Kiwi was up 0.7% at 59.09 US cents. Number 2, the Reserve Bank of Australia's April the 1st board meeting minutes were released yesterday, and they support ANZ researchers' view that rates could be cut in May, July and August, says ANZ senior economist Adelaide Timbrell. Adelaide says the minutes suggest the RBA is not necessarily looking at tariff developments as an inflationary shock.
They also spoke multiple times in the minutes about being open to change. And what I mean by that is they talked about they need to be, in quotes, cautious and alert to the evolving economic outlook. And they also were quoted saying monetary policy should be forward-looking. All of these things to me suggest the door was already open to a May cut before the US tariff announcements, and those tariff announcements really support that call.
Number 3. Adelaide says a speech last week by the RBA governor indicated the key focus for the central bank will be how global uncertainty affects decision-making of Australian businesses and households.
At ANZ Research, we consider this to be the main transmission through which these tariffs will hit the Australian economic growth. It's not about Australia's exports to the US. It's about how global growth affects our decisions and how our decisions affect economic growth. We currently see the Reserve Bank easing 3 times in May, July and August, and this amount of stimulus should be enough to keep the economy in a stable position.
Number 4. Along those lines, ANZ's Roy Morgan Australian Consumer Confidence Survey yesterday showed signs that the global uncertainty is transmitting through into local confidence, with the index dropping 2.6 points last week to 84.2. ANZ economist Sophia Angala says short-term confidence in the next 12 months led the drop.
This is the first weekly survey that we've had that has now occurred entirely after the US tariff announcements. All financial and economic condition sub-indices are now sitting below the averages that they held over the second half of 2024. So that drop that we saw in the headline series and across most sub-indices last week likely reflects the more pessimistic global backdrop following US trade policy uncertainty.
Number 5. China's GDP data for the first 3 months of the year out today might be considered old news with those US tariffs kicking in from the second quarter. ANZ economist Vicky Xiao Zhou is forecasting an annual rate of 5.2% to be followed by slower growth in the second half of the year.
We maintain our GDP forecast for 2025 at 4.8%. Despite the shock we've seen in the tariff news, we are confident that the Chinese policymaker will defend its 5% GDP growth target by announcing more supportive stimulus, especially supporting the property market and then the stock market to keep the positive wealth effect and then continue stimulus the household to spend.
Vicky Xiao Zhou there. Now, on part 2 of a bonus deep dive interview on the US dollar's reserve currency status, ANZ senior rate strategist Jack Chambers talks about how important the US dollar and its special relationship with the Australian dollar is to Australia's pension funds, which are now collectively the 3rd largest private savings pool in the world.
So one of the main channel there is the Australian dollar as a risk currency. It tends to appreciate when there's risk on moves and equities moving higher, and when there are risk off moves and equities are falling, the Aussie depreciates versus the US dollar. What that means is when superannuation funds buy offshore equities, which is where a large chunk of their allocation is, about a third of superannuation fund assets are in offshore equities, they generally don't hedge a huge amount of the FX exposure when they're buying US dollar assets. Remember that super funds naturally have AUD assets, the cash that households, Australians, put into their super. But then super funds diversify by buying non-Australian dollar assets, particularly US equities. It's probably been an overweight sector. They haven't had to hedge a lot of that exposure. Their hedge ratio, they only hedge around, let's say, 22, 23% of their offshore equities. The others are unhedged from an FX basis. They haven't had to hedge it because generally the Australian dollar and US equities are pretty well correlated. So there's almost a natural hedge. The risk becomes if that correlation breaks down, if the Australian dollar doesn't depreciate versus the US dollar whilst equities fall, then that natural hedge is broken down. That hasn't completely gone away, but we have seen in the last 2 weeks, there have been 2 days in which the S&P 500 fell more than 3%. And the Aussie-US cross didn't fall. There's only been a handful of those days in the past 35 years, basically during the financial crisis were most of those days. It's very rare for that to occur. We can't be sure that there's been some fundamental shift in the correlation between the Aussie and equities. It's probably unlikely. But at the margin, even if that relationship has changed a little bit, even if the Aussie is just a bit less sensitive to moves in US equities now, it probably drives that super funds will want to increase their hedge ratios just a little bit at the margins, just to reflect that slightly changed relationship.
And what would that do to costs and the Aussie dollar if we saw a more substantial move?
There are a few things. It means that super funds would be selling less AUD in spot FX. That's been one of the big flows. They've been big sellers of AUD to buy offshore currencies to fund purchases of offshore assets. That could fall a little bit. You'd also see them essentially lending more AUD into funding markets. There's two-way flow that goes on in FX swap, where essentially there's two transactions. Someone's selling AUD now with the promise of buying them back in the future, or vice versa, which is kind of the transaction a super fund does. A lot of other institutions sit on the other side of that flow. So what it means is in funding markets, where people are borrowing AUD for future needs, there will be a slight increase in the abundance of AUD, just because super funds will be lending more Aussie into that market. That means lower hedging costs for other people that want to borrow Australian dollars in the market at the margins. It'll be interesting to see how that plays out, because there's always a push and a pull. If super funds do that, if super funds are lending more, it incentivizes other people to borrow a bit more because the cost of doing so falls a little bit.
And just finally, if we were looking at the centrality of the US dollar perhaps becoming less central, what would be the sort of events or signs or actions that might make the US dollar less central?
I think in some ways the policy uncertainty of the last couple of weeks are the main things, where it feels like the market was less willing to look through that and assume that it's all just noise and there will be a temporary macroeconomic effect. Markets were looking at it a bit more seriously about, does this fundamentally change where I should have my asset allocation? The way we're going to see that is if there's a continued sell-off in long-end treasuries, if we see further underperformance of US equities versus European equities or rest of world equities, if we see continued underperformance of the US dollar or the DXY index. If you combine all those things where historical correlations start to break down, that kind of gives you a sign that there are fundamental shifts in flows going on. We're not going to know this on a weekly basis or a monthly basis. It's going to take us a long time. It's something that you'll know in hindsight. But the price action we saw last week was the start of that. If I think about future data where we might get some hard data on this, it's things like central bank holdings or allocations to US dollar reserves. At the moment, central bank reserves, the money they use, their assets, more than 50%, close to around 60% of central bank reserves are in US dollars. That it's not unforeseeable that starts to fall. Not that it goes below 40 or 30%, but it starts to incrementally shift a bit more towards euros and maybe even to Aussie AUD asset reserves. It's those sort of data which will give us the actual hard signal that that centrality is diminishing.
Jack Chambers there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, April the 16th. Catch you tomorrow with an analysis of China's Q1 GDP performance ahead of those tariffs kicking in. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.